In the early 1600s, the DEIC, or Dutch East India Company, employed dozens of ships across well-known trade routes to trade gold, spices, and other exotic items all around the world. In order to fund these voyages, they called for potential investors to give them money in exchange for a percentage of profits made on the voyage. This practice provided the perfect catalyst for the DEIC to have greater voyages and even greater profits. On this day, the DEIC unknowingly made the world's first stock market. In more modern times, the stock market is significantly more complicated, with 150 different pieces of data combined to generate just over 2.1 million unique signals that are used to predict the ups and downs. The modern stock market allows for potential investors to cash in on the financial world of the great corporations of today. Many companies nowadays open the market to investors by offering an IPO, or initial public offering. Let's say a new company arises with big ambitions. The first thing they'll need to do is to find a long list of savvy investors waiting to make money. These investors will then sponsor the company's initial public offering by investing into it. Essentially, an IPO is when a company's growth is large enough for it to transition from private to public ownership. This could mean that rather than a particular set of individuals collectively owning the company, they could each choose to own a smaller portion and allow for the remainder of it to be sold to people all over the world. For the investors who choose to buy into a stock, they're now shareholders or partial owners of the company. The investments provided by these shareholders allow for the company to grow. As the company grows, the price of the stock can increase as well, which in turn makes the demand for the stock increase. The higher the value of the company's stock, the higher the investment is worth. However, this principle can apply in reverse as well. If the price of a stock begins to fall, investors may choose to sell their shares of the company in order to try to turn a profit for themselves before the stock falls again. This can leave people with major losses, that is, until the company's share price returns to what it was originally, which is the case in most circumstances. Companies can lose value for many reasons, most predominantly being due to the business's health or the way that shareholders interpret decisions made by the company. These factors can also be economic reports such as earnings, the general market's economic strength, changes in leadership, bad publicity, or even new laws or trade policy. These can all affect the way that a stock performs in the market. When a company's price begins to diminish, it also has the potential to lose investors, which in turn can lead to an actual loss in the company's value. Additionally, some people may choose to sell their stocks for more personal reasons. For example, they may need money to buy a car, or maybe they just want to get the most recent video game. All of these individual factors and variables can cause noise in the day-to-day market. Human confidence in the market has the power to trigger everything from economic booms to financial crisis. On that account, it's important for an investor to understand trading psychology because it can help to predict what others are thinking, and that information can provide a big advantage. On the other hand, this is a double-sided blade. If you can somehow understand and hone the skill of trading psychology, you can learn to master the market. However, due to the difficulty of this, many professionals promote a long-term investing strategy because less psychology is needed to trade. In spite of that, short-term investing may be a more viable strategy for teenagers due to the fact that they can afford to take larger risks and losses. Oftentimes, larger risk leads to large rewards. Thanks for watching. We hope you learned something. Make sure to subscribe and hit the bell so you'll be notified when our next video comes out. We also have a TikTok page where we post similar content, all about investing and finance, so feel free to check that out too. Thanks for watching, and have a good one.